Welcome to the deep dive. Today, we're really getting into something fundamental for understanding any country's economy.
That's right. We're looking at national income accounting.
It might sound a bit, technical, but stick with us. This framework is actually super important for seeing the bigger economic picture.
Absolutely. Our mission today really is to unpack these ideas and show you why they have real-world significance. We've got some solid source material to work from.
Okay, so let's dive in. Our sources tell us national income accounting basically provides the structure for those big economic models.
Right, the ones that try to predict economic trends. And it's also how we measure, how well the economy is actually performing.
Is it growing? Is it struggling? That kind of thing.
Exactly. And it helps governments figure out policy too by understanding where the income is coming from and going.
So at its heart, what are we talking about? National income and national product.
Yeah, essentially. National income is the total earnings, think wages, profits, rent from labor, capital, and land. And national product is the total flow of all the goods and services produced. The key thing is that national income is basically the money value, the market value of all that output in a given period, like a year.
Got it. So let's break down some of the main concepts. The big one everyone knows, GDP, gross domestic product.
Right. GDP. So the sources define it as the total market value of all final goods and services.
Final being the key word there.
Absolutely final. Things like rice, bread, healthcare services, even concert tickets, everything produced within a country's borders in a year.
It really captures the sheer scale, doesn't it?
It does. It's seen as the most comprehensive measure of a nation's output. It's the main tool we use to track overall economic performance.
And there's that formula people often see.
Yeah.
GDP plus I plus G plus NX. Let's quickly run through those letters.
Sure. C is consumption. That's households spending money on everyday things, food, clothes, movies,
Like us buying stuff.
pretty much. Then I is investment. This is businesses spending on things like new machinery, factories, or even new houses being built. G is government expenditure spending on roads, schools, defense, all that public stuff.
Right.
And NX is net exports. That's simply a country's exports minus its imports.
Exports minus imports. Makes sense. Now, I often hear about nominal GDP versus real GDP. What's the difference we should care about?
Yeah, that's a really crucial distinction. Nominal GDP uses the prices from the actual year the goods were produced.
So current prices.
Exactly. Which means if prices just go up inflation, nominal GDP can rise, even if we're not actually producing more stuff.
Okay, so it can be a bit misleading.
It can be. That's why we have real GDP. Real GDP adjusts for those price changes. It uses prices from a specific base year.
Constant prices.
Right, so it gives you a much clearer picture of the actual volume of goods and services being produced. It tells you if output itself is truly growing.
So real GDP is the better measure for tracking actual economic growth, not just price increases.
Definitely. If you want to know if the economy is actually expanding production, you look at real GDP growth. It separates the quantity change from the price change.
Okay. And related to prices, the source mentions the GDP deflator. What role does that play?
The GDP deflator is basically a measure of the overall price level in the economy. It's calculated by taking nominal GDP, dividing it by real GDP, and multiplying by 100.
So it captures the difference between the two.
Precisely. It's a key indicator for measuring inflation across the whole economy.
Got it. The source also distinguishes between GDP at market price and GDP at factor cost. Can you break that down?
Sure, GDP at market price is what things actually sell for in the shops, including indirect taxes like VAT or sales tax.
The price we pay.
Right. GDP at factor cost looks at it differently. It's the total income earned by the factors of production, the land, labor, capital involved. It strips out those indirect taxes and adds in any government subsidies.
So it's more about the underlying production cost.
Kind of, yeah. The difference is those net indirect taxes, so indirect taxes minus subsidies. GDP at factor cost equals GDP at market price minus those net indirect taxes.
Okay, clear. Now let's shift slightly to gross national product, GNP. How is that different from GDP?
Okay, so GDP focuses on where the production happens inside the country's borders. GNP focuses on who owns the factors of production.
Ownership versus location.
Exactly. GNP is the total market value of final goods and services produced by factors owned by a country's residents, no matter where in the world they are located.
So if a UK company owns a factory in France, its output counts towards UK GNP.
Correct. but it would count towards France's GDP because it's produced in France.
Right.
So to get from GDP to GNP, you add the income earned by your citizens abroad and subtract the income earned by foreigners within your country.
And that difference has a name.
Yep, net factor income from abroad. So GNP equals GDP plus net factor income from abroad.
Okay. And like GDP, it can be at market prices or factor costs too.
Yes, the same logic applies with net indirect taxes making the difference.
Good. Next up in the chain, net national product, NNP. What's the net about?
The net accounts for depreciation. Think of it as the wear and tear on capital goods machines getting old, buildings needing repair, technology becoming obsolete.
The value lost as things get used up or outdated.
Precisely. It's also called the capital consumption allowance. So take GNP and subtract this depreciation value to get NNP.
NNP minus depreciation. Simple enough.
And again, you can have NNP at market prices or NNP at factor cost.
And I see a note here that NNP at factor cost is actually another name for national income.
You got it. That's a key connection. National income, or NI, represents the total income earned by all those factors of production, the wages, rent, interest, profits.
So NI is NNP at factor cost.
Right. Or you could think of it as NNP at market price minus those net indirect taxes. Or even starting from GNP. GNP minus depreciation minus net indirect taxes. It all links together.
Okay, building on this. Personal income, PI. How does that fit in? Is it different from national income?
It is slightly different, yes. Personal income is the income that individuals actually receive before they pay direct taxes like income tax.
Money landing in people's bank accounts, sort of.
Basically, yes. It differs from national income because NI is about income generated from production. PI includes things like transfer payments, which aren't directly linked to current production.
Transfer payments? Like what?
Things like unemployment benefits, pensions, Social Security payments, money the government gives to people, but not in exchange for a good or service produced right now.
Ah, okay.
So to get personal income, you start with national income, then you subtract things like corporate taxes and Social Security contributions because businesses in the system keep that. Individuals don't receive it directly, but you add those transfer payments and also net interest payments individuals receive.
So it reflects the actual flow of cash to people before income tax.
Exactly.
Which leads us nicely to disposable income, DI. That sounds like the bottom line for individuals.
It is. Disposable income is what households have left after they've paid their direct taxes. It's the money they can actually choose to spend or save.
So DI, personal income minus direct taxes.
Or you can think of it as DI equals consumption plus saving, what people do with the money they have left.
Right. And the last main concept here is per capita income. Seems straightforward.
Yeah, that one's pretty simple conceptually. You just take the national income and divide it by the total population.
Gives you an average income per person.
Exactly. It's often used for comparing general living standards between countries, though obviously it's just an average.
Okay, so that's a good rundown of the different measures. Now, how do economists actually calculate these figures, specifically GDP? The source mentions 3 methods.
Yes, 3 main ways to approach it. The production method, the expenditure method, and the income method.
And they should all ideally give the same answer.
In theory, yes. They're looking at the same economic activity from different angles. In practice, there can be small differences because data collection isn't perfect. This is often called the statistical discrepancy.
Let's start with the production method, sometimes called the output method.
Okay. This method basically sums up the value of all the final goods and services produced in the economy, valued at their market prices.
And there are 2 ways to do that. Final good versus value added.
Right. The final good approach just tries to count the value of the finished items. The car, the loaf of bread, the haircut.
Seems simple, but maybe tricky not to miss things or double count.
It can be. That's why the value-added approach is often preferred. It looks at each stage of production.
How does that work?
You calculate the value added at each step. That's the value of the output at that stage minus the cost of the intermediate goods used.
Intermediate goods, like the flour used to make the bread.
Exactly. So you take the baker's sales revenue from the bread, but you subtract what they paid the miller for the flour. You take the miller's revenue, subtract what they paid the farmer for the wheat, and so on.
Ah, I see. So you only count the new value created at each stage.
Precisely. The source uses a great bread example. Farmer, miller, baker, delivery. You sum the value added by each, and it gives you the final market price of the bread without counting the wheat value multiple times. It neatly avoids double counting.
That's quite clever.
Okay.
Okay, second method, expenditure. We touched on the formula C plus I plus G plus NX earlier.
That's right. This method adds up all the spending on domestically produced final goods and services.
So C is household consumption spending.
I is gross private investment spending. Businesses buying equipment, building factories, changes in inventories.
G is government spending on public goods and services.
And NX is net exports, exports minus imports.
Spending by different groups on the final output.
Exactly. And crucially, the source notes things we don't count here. Spending on secondhand goods isn't counted because they weren't produced this year.
Makes sense.
Purely financial transactions like buying stocks or bonds are also out. No new good or services produced. And those transfer payments we mentioned earlier are excluded from G because the government isn't getting a current good or service in return. Again, focus on final goods produced this year.
Okay. And the third angle is the income method.
Yes. This one sums up all the incomes earned by the factors of production for contributing to that output.
So looking at where the money from the spending ends up.
Exactly. You add up things like wages and salaries paid to labor,
Okay.
rents paid for land and property, interest paid on capital, profits earned by businesses.
All the earnings.
Yes. Plus, you need to add in allowances for depreciation, because that's a cost of producing, and also those net indirect taxes to get back to the market price valuation of GDP.
So it's adding up all the costs and earnings involved in production.
That's a good way to think about it. The source gives an identity, GDP plus S plus T consumption plus private saving plus net taxes, showing how the income generated is used.
And exclusions here. Similar to the expenditure side.
Yes. Income from selling an existing asset isn't counted, no new production. Income from financial transactions without underlying production is out. Transfer payments received are also excluded from this calculation of generated income. Again, the value-added idea helps prevent double counting income at intermediate stages.
It's fascinating how these three different views should, in principle, triangulate the same number.
Yeah.
But I imagine actually doing this measurement in the real world must be incredibly difficult.
Oh, absolutely. The sources definitely highlight major challenges. It's far from a perfect science.
Like what? What are the main problems?
Well, a big one, especially in developing countries, the source mentions Nepal as an example, is just the lack of good data, inadequacy of data.
How so?
Think about the informal sector, sometimes called the black economy or shadow economy. Lots of transactions happen off the books, cash in hand. Small businesses might not keep detailed accounts. It's really hard to capture all that activity accurately.
So the official GDP figures might be significantly underestimating the real level of economic activity.
Very likely in many cases, yes. Another issue is the non-monetized sector.
Meaning?
Things people produce and consume themselves without any money changing hands. Like a farmer growing vegetables for their own family. That's real production, and it doesn't enter the market statistics easily.
Right. And calculating depreciation accurately.
That's another tough one. There's no single standard formula for how quickly machines wear out or technology becomes obsolete. Different assumptions can lead to different NNP figures.
And inventories.
Yes.
Goods made but not sold yet.
Yeah, accounting correctly for changes in inventories, making sure you count goods when they're produced, not just when they're sold, and adjusting for goods sold this year but made last year. It's technically a complex.
Okay, what else? The source brings up the environment.
Yes, and this is a huge point. Standard GDP doesn't account for environmental degradation.
How does that work? Or not work, rather?
Well, say you cut down a forest and sell the timber. The value of the timber gets added to GDP. But the loss of the forest, the environmental damage, the loss of a future resource, loss of biodiversity isn't subtracted. So GDP can go up even while the country is depleting its natural wealth, which isn't sustainable.
That seems like a massive blind spot. Are people trying to fix that?
Yes, there's a lot of work on green GDP or adjusted environmental accounts, but it's complex and not yet standard practice everywhere.
Any other measurement headaches?
Lack of occupational specialization in some economies. People might do multiple jobs, farming part-time, driving a taxi part-time, making it hard to classify their income accurately.
I can see that.
And then there's the ever-present danger of double counting, despite the value-added method, making sure you only count the final value. The source uses sugar cane and sugar. You can't just add the value of the cane and the value of the sugar made from it.
You have to subtract the input costs.
Exactly. And finally, illegal activities. Drug trafficking, smuggling, etc. That generates income, but it's deliberately hidden and excluded from official GDP figures.
Wow. So collecting this data is really, really challenging. It makes you wonder how accurate the final numbers really are.
There's always a margin of error, definitely. But despite these difficulties, national income accounting is still incredibly useful.
Why? What's the importance given the limitations?
Well, as the source lays out, it's still the best overall index we have of a country's economic pulse. It gives us a broad picture of activity levels.
Okay.
It's vital for economic planning. Governments use these figures to set policies, forecast revenues, plan budgets, and track progress towards development goals.
And for businesses?
Businesses use GDP trends and forecasts to make decisions about investment, expansion, hiring. It gives them a sense of the overall economic climate.
So it affects real-world decisions.
Absolutely. And it provides a general indicator of the economic condition of the people. Is average income rising or falling?
Through things like per capita income.
Exactly. Which also allows for those, albeit rough, international comparisons of economic well-being. And it even informs things like how much a country might be expected to contribute to international organizations like the UN or IMF.
So it really is a foundational data set, despite the fuzziness around the edges.
Definitely. It provides a common language and framework for discussing the economy, even with all the caveats.
Okay, so let's wrap this up. We've taken a pretty deep dive into national income accounting today. We've looked at the key concepts, GDP, GNP, NNP, national income, right down to personal and disposable income.
We've explored the three ways accountants try to measure it: production, expenditure, and income, each giving a different perspective on the same flow.
And we've spent some important time on the difficulties, the challenges in getting these numbers right, from data gaps and non-market activity to depreciation and environmental costs.
Which are crucial to keep in mind when you see these figures reported.
Definitely.
Mm.
But ultimately, it's clear this whole system, this framework, is absolutely essential for anyone trying to understand how an economy works, how it's performing, and where it might be heading.
Couldn't agree more. And, considering all those limitations we discussed, particularly things like the environmental costs or unpaid work that aren't fully captured, it does make you think, doesn't it?
How so?
Well, it leaves us with a question, maybe for you listening. If GDP and these related measures have blind spots, how else might we evaluate a nation's well-being and progress? What other indicators should we be looking at alongside the purely economic ones?
That's a really provocative thought to end on. What truly constitutes national progress? Definitely something to think about.